Hello, my name is Fatimah Romaysah Binti Radwel and my metric number is BB20110721. My title is Loan Analysis and this assignment was prepared to Prof. Dr. Wong Hock Sen and this subject is Money and Banking Section 1 and this is my individual presentation. So let's get started. 1.0 Introduction. According to the Oxford Dictionary of Finance and Banking, loan can be defined as money lent on condition that it is repaid, either in installment or all at once, on agreed debts, and usually that the borrower pays the lender an agreed rate of interest unless it is an interest-free loan. Meanwhile, the loan account can be defined as an account opened by a bank in the name of a customer to whom it has granted a loan, rather than an overdraft facility. The amount of the loan is debited to this account and any repayment is credited. Interest is charged on the full amount of the loan less any repayments. 2.0 Lending Guidelines. There are 5 steps of lending guidelines. Firstly, make sure to check credit score. The applicant's or the borrower's credit score is one of the significant factors that the lender consider when decide whether to accept or decline the loan applications. Secondly, the creditor will implement an income requirements policy on the borrower to ensure that the borrower can repay the loan on time accordingly to their ability. Thirdly, the debt-income ratio DTI is a percentage that represents the portion of a borrower's gross monthly income that goes toward monthly debt service. Fourthly, insecure personal and loan applications. Lender will use valuable assets as collateral. And last but not least, lenders require borrowers to pay an initial personal loan fee in order for the application process to be completed, as there are several costs that must be highlighted during the initial loan application process. 3.0 Loan Application and Loan Analysis. So basically, there are 2 parts that I want to describe in this subtopic. So the loan application refers to the entire process beginning with the negotiation in terms and ending with the loan being reviewed and approved by the withdrawal. And secondly, the lending institution should provide accurate and up-to-date information to assist the company in tracking loan repayment via the detailed steps outlined in the loan guarantee. 4.0 The Balance Sheet and Loan Analysis. As you can see in the screen, I have given you an example of the Statement of Financial Position. The Statement of Financial Positions, also known as the balance sheet, is a medium used in analyzing loans made so that the loan repayment ratio can be calculated correctly, while knowing the company's performance in managing the loans, where the balance sheet shows the status of both current and fixed assets to would-be borrowers. Secondly, the Statement of Financial Position shows the movement of inventory and cash flows to assess the customer's strength and the financial strength when seeking to make a loan. 5.0 Loan Formula. The loan formula and the PV have a lot in common, where the loan interest rate represents the opportunity cost, the loan amount represents the investment, and the loan repayment represents the investment cash flow. Because of this and other similarities between the PV model and the loan formula, lending institution can use PV tools to analyze different types of loans and interest rates. The loan formula will identify alternative methods and the relationship between loan tenure and loan repayment size. Furthermore, a break-even point, for example by refinancing loans and effective interest rates for various hidden interest rate loans, will be emphasized. So as you see in the screen, I have give you 2 formula. First formula is effective return rate, and the second formula is allowing a large number of periods to be compounded results in a special compounding formula. This concept is expressed as the formula above and in the screen, and it is very important to calculating the loan analysis. 6.0 Constant Payment Loans. After determining the interest rates in the financial model, we can use the PV model to analyze the different types of common loans and continuous repayment loans. A continuous repayment loan is one that it is repaid over time with the same A series of payments. Furthermore, the continuous payments may occur several periods over n years, totaling MN in payment. 7.0 The refinance problem. Typical financial transaction is the refinancing of a continuous repayment loan, in which case a reasonable borrower will refinance if the current interest rate is lower than the interest rate on the person's existing loan. The refinancing problem is clearly an NPV problem, and its solutions requires us to identify sustainable investments, because sustainable investment can accelerate our profits, whereas challenging investment put a lending institution at a great risk and are likely to cause problems in the future. The next step is to determine the break-even points for refinance continuous repayment loans. 8.0 Loan risk. Loan risk analysis is used to calculate the cost of a loan. Furthermore, loan risk is a byproduct of the credit allocation process, in which the lending institution must weigh the potential benefits and costs of the loan. When a person makes a loan from any bank or lending institutions, this process will take place. So in this screen, I will show with you on how to calculate the credit risk. The credit risk is equal to default probability times exposures times loss rate, whereas the default probability is the possibility of a debtor failing to make his debt payment, while the exposure is the total amount that the lender is expected to receive. In most cases, it is simply the debtor's borrowed amount plus interest payments. Last but not least, the loss rate equal to 1 minus recovery rate, where recovery rate is the percentage of total amount recoverable in the debtor defaults. Credit risk analysis examine each of the credit risk determinants in order to reduce an organization's aggregate risk. 9.0 Consumer loan. Consumer loan consists of two parts, which is secure loan and unsecured loan. Secure consumer's loan is one that is secured by collateral or assets that are used to cover the loan if the borrower fails to repay it. Secure loans typically provide borrowers with a larger loan amount, a longer repayment period, and a lower interest rates, whereas the unsecured consumer's loans are those that are not secured by the collateral. Unsecured loans typically provide borrowers with a limited amount of funding, a shorter repayment period, and a higher interest rates. Lenders face increased risk because loans are not backed by assets. On the other side of 9.0, there are open consumer loan and closed-end consumer loan. Open consumer loan, also known as a revolving credit, is one in which the borrower can use the loan for any type of purchase but must repay the minimum amount of the loan plus interest by a specified date. And the closed-end consumer loan, also known as the installment credit, is a type of credit that is used to finance specific purchases. The consumer makes equal monthly repayments over a set period of time with closed-end loans. Last but not least, 10.0 Conclusions. Loan analysis is a broad and fascinating topic to study and then apply in everyday life. However, I concentrate on several subtopics related to the loan analysis in my individual assignments, including the lending guidelines, loan applications and loan analysis, the balance sheets and loan analysis, loan formula, constant payment loan, the refinance problem, loan risk, and consumer loans, where each subtopic has its own function and very important to be studied and applied in loan analysis. Thanks and stay safe. So I put my information such as my email and my number phone in case there was a problem that I need to know.